Hello, and welcome to What's the Deal on JP Morgan's Making Sense. I'm your host, Amaury Guzman from the Leverage Finance Desk. With us here today, I have Lisandro Miguens, a managing director at JP Morgan and the head of the Latin American Debt Capital Markets Desk. Liso, thank you for joining us today.
Amaury, thank you for having me. It's a pleasure.
So let's start from the top with the fundamentals. For the benefit of our listeners who may not be familiar with the funding dynamics in the region, can you explain what debt capital markets entails in Latin America?
Sure. The way I like to describe, particularly for your audience, is to look at the similarities and the differences with the US market. So in terms of the similarities, we still have a bond market and a loan market, similar to you. The bond market is characterized mostly by 144A, traditional 144A issuance. We have a certain issuers doing SEC register. And then we have two niche markets, which are smaller in size than the traditional, which are the private placement and the asset-backed securities. Then moving on to the loan market is mainly the borrowers are concentrated in TLA and RCF, which is like 90% of the market. And then the rest is direct lending. We have some direct lending, we call it alternative financing in Latin America. That is a growing market that has been growing over the years, but still is very small. And in terms of the TLB, which is a very deep market in the US, we don't have that in Latin America. Some borrowers in the TLB, there's a few borrowers, like 3 or 4 only, which are names that are very related to the high yield market, either by ownership or they have some assets in the US, but it's a very niche, small market. When you look at the differences are also big in the sense that, for example, we have in Latin America an international capital markets and in local markets. What does that mean? When I say local markets, I'm meaning local denominated securities in the currency of their own country, local listing, local law, local investors, pure local markets. Interestingly enough, that market, it is 2 times larger than the international capital markets for Latin American issuers. So at the end of the day, 70% of all financing in Latin America is done in the local markets, and only 30% of the financing is the one that is done in the international capital markets. The local markets are dominated by local players, local banks, and the international capital markets is dominated by companies or banks like JP Morgan. The second difference is the penetration and the size. So when you think about penetration of the financing market in the US, all the financing markets in the US or capital markets in the US comprise 170% of the GDP of the US. While if you look in Latin America, it's only 60%. So clearly there is a big difference between how much penetrated is the capital markets in North America than in Latin. And then the sheer size of the US market is 10 times larger than the one in Latin America. So the total capital markets in the US is $50 trillion, while the capital market size in Latin America is only $4 trillion. And then the last one, difference is market sentiment. The market sentiment in Latin America is not only driven by the US capital markets, US rates, which we'll talk about in the rest of the podcast, but also is driven by idiosyncratic events in Latin America, FX currencies, current account deficits, political cycles in Latin America, commodity prices. So at the end of the day, when you look about market sentiment for an issuer in Latin America, borrower in Latin America, you need to think about what's going on in the US, but also all these factors are affecting the Latin American space.
Thank you for that, Lee. So I think this compare and contrast that you've done vis-a-vis the US market versus the dynamics, the products that we see in the Latin American market is very helpful for our listeners. Just double clicking a little bit into the products that are employed for capital raising in Latin America, why don't we start with international bonds and the drivers to that segment of the market?
Sure. So basically, as I said before, the international capital markets is a complement to the local market. So when you looked at the local capital markets, you have 80% of the financing for sovereigns. The local market is 80% sovereigns and 20% corporates. So most of the sovereigns are financing themselves in the local markets. And in the international capital markets, it's 60% sovereigns, 40% corporates. So when you think about international capital markets for LATAM, it is still mainly focused on the sovereign side, but still 40% is corporates. Use of proceeds are usually large investments, refi of existing debt. In the case of the sovereigns, managing the budget, which all the countries have fiscal deficits, so they need to manage that. And then in general, corporate purposes. When you think about the high yield and high grade component, in the high grade is usually senior unsecured, You have also subordinated structures that allow issuers to go to market with hybrid securities and AT1s in the case of banks. In the case of high yield, you have senior unsecured financings, and you have two types of high yield differently from the US. The first type is typical that the US are used to, which is the capital structure of the company is such that it is a high yield issuer and has high yield components in terms of indenture, governance, etc. But then you have a subsegment which is top companies, which has an investment grade capital structure, but happens to be in a country that is non-investment grade. And those are non-investment grade issuers. But the way that it's being treated by the market is more like an investment grade, even though it's a non-investment grade rating because of the country.
That's very interesting. And I just want to make a pause in this point you just mentioned. Here in the US, we're used to having very deep investment grade and high yield market. But you're saying that in LATAM or in Latin America, we could have a company with an investment grade credit profile, yet just because of its jurisdiction where it's based, it could be rated by the agencies as a high yield instrument. Is that right?
Correct. Yeah, that's right. When you looked at that instrument, at the end of the day, it's going to be an instrument that look like more like an investment grade in terms of the covenants, in terms of the indenture. Why? Because when you looked at the company isolated from the zip code, it is an investment grade type of company. So the indenture will be such that will equal an investment grade indenture.
Got it. You also mentioned that in Latin America, issuers employ what the market calls hybrid bonds. It's an instrument that we don't typically see in the US. I think we more often see preferred securities for funding at that part of the capital structure. Do you mind just fleshing out in a little bit more detail what hybrid bonds are?
Yeah, sure. So hybrid bonds are highly subordinated debt instruments like quasi-equity, and that has certain features that make them like that. One is the long tenor or the perpetual maturity. The second aspect is it has to be deep subordinated on top of the equity, below all the rest of the debt. And last but not least is the discretionary to pay coupons. So those three elements make that hybrid security such that can be treated by rating agencies and sometimes accounting purposes as partly equity. We've been using this instrument, I like in the US and high-grade market as well. In Europe has been highly used. Also in Latin America for companies that they've been used in the context of M&A, that they need to put more capital because they're going through an M&A process and they need more capital to retain the ratings. Sometimes for reasons of high leverage because of the cycle. Remember that in Latin America, we have a lot of commodity companies. Commodity companies are very cyclical in terms of the revenues, and sometimes in the low part of the cycle, they need some cushion of equity. And so they use this instrument to basically support the low cycle of those companies.
Got it. If I now were to try to zoom out a little bit and break down the volume of the market as of most recently in terms of industries, how would you describe that?
So when you think about the market, you have the bond market and the loan market. The loan market, there's no data that we can tell you where the industries of the issuers are coming from. But I would say that mimics the bond market. So if I take the bond market capitalization of Latin America, you're going to see a very fragmented and at the same time diverse industries represented in the indices. And we'll talk about the indices later. And it's very interesting because if you looked at the breakup, you're going to see that 20% of the issuance come from financial institutions, 20% from energy, 15% from utilities, and 10% from three different sectors, 10% each: mining, consumer, telecom, and then other industries, pharma, agribusiness, transportation, make up the 15% remaining. So it's very diverse, given the sense that most of the industries have access to the markets, not only the more strategic ones. I mean, we can think about commodity cycle or commodity driven because of the force of or the strength of the commodities in Latin America, or you can think about basic infrastructure for the good for the country, but also the other more marginal industries have access to the capital markets.
Yeah, that's clear from that breakdown. Pivoting away in terms of tracking the market, I know that, for instance, in my day-to-day job on the leverage finance desk, I observe the high yield index, the leverage loan index, and I point my clients and as well as investors and lenders towards that to try to get a sense of relative performance. What typical benchmarks do you observe to assess the performance of the asset class within Latin America?
Basically, you have two, and both are within the families of indices of JP Morgan. One is the MB and the second one is the SEMB. The MB is the one that comprises all the sovereign issuers and quasi-sovereigns. I mean, all these companies that they are basically partly or totally owned by governments. And then you have the SEMB, which is the corporate index. In order to be part of the MB, you need to have an issuance at the minimum of $500 million and certain liquidity in the secondary market. And in order to be on the SEMB, you need to have a minimum of $300 million and also certain amount of minimum liquidity to require. I don't think there is any other indices in Latin America that try to compete with these two, and this is widely used in the industry.
I know that we've so far spent a lot of time diving deep into the intricacies of the bond market, but I now want to pivot into loans. Why don't you kind of walk us through the role that loans play in financing in Latin America?
Perfect. So first and foremost, if you think about size, just to give an idea, the size of the loan versus the bond market in LATAM, the loan market is only 25% of the bond market, international bond market in LATAM. So it's the market cap of the loan market is around $300 billion, while the bond market is $1.2 trillion. Then the second is most of the syndicated loans are New York law. And basically you have mostly international banks participating, but also you have some local banks participating because some local banks, they have funding in dollars. So they use those deposits to participate, but like more marginal. Obviously, the syndicated loan market is an additional source of financing to the local markets and to the international capital markets. Those three groups of financings are the ones that they make up the majority of the financing for companies in the region. Most of the participant banks are international banks that we all know. I mean, in the US, are going to be the typical US banks. You're going to have the French banks, very active. You have Italian banks, Spanish banks, super active in Latin America, obviously. The Netherlands. Also, you have Middle East banks and Asian banks. And on top of that, regional banks. We have some regional banks in Latin America. They have a regional presence and they like to participate in some of these loans. So it is really widely distributed between the different banks. It is a relationship lending, TLA. Pricing tend to be very aggressive, particularly below the bond market. That's why the clients like this market a lot. When you think about sizes as well, we issue around between $50 and $75 billion of loans per year. The tenors are between 3 and 5 years, amortizing, some of them balloon payments. And then you have the sub-segment that I talked about with you before, which is the project finance and the alternative financing. Typically, project finance, greenfield and brownfield projects in Latin America, or companies that they have highly contracted cash flows. And then they can go to 7 years. Mini-perm in that market is very common, so they go further than 5 years, and usually it's amortizing. Then in terms of the alternative financing, which is more niche market for solutions that are not driven by the traditional syndicated loan market, that is a growing market, as I said before. Don't have a size per se because it's very private, difficult to measure the size, but you can see around 5 to 10 deals per year in the region.
Got it. Thank you for that. It sounds like you guys have been very active in the sector and you employ some of the features that we use here in the US in terms of kind of the loan market for be able to originate financing for borrowers in the region, but then perhaps other kind of shy away from other features just to cater to the bespoke needs of the borrowers down there. We've been very busy here in the US over the last couple of years with financing in the market, specifically in high yield, which is where I kind of spend most of my time. Can we now pivot to speaking to the drivers to primary activity in the market and the depth of demand for both bonds and loans across the region?
Great. So the yearly volumes in the bond market ranges between $70 billion and $150 billion. $70 billion was a low mark in 2022, as we all know what happened in the markets that year. And $150 billion is a high mark that we saw last year in 2024. So far this year, we printed in 6 months $100 billion. So we are basically tracking a number that can end up being a record volume of issuance and historical basis. When you think about how deep that market can be in terms of how much you can raise being an issuer in that market, you can raise between $500 million or $300 million and $2 billion. I think the highest mark that we've seen for corporates in the region has been $2 billion. You can go from 10 to 30 years, no problem. In the local markets, the tenors are shorter, 5 to 7, we tend to use international capital markets more for the 10 to 30-year mark, even though we can do 5 years, no problem. When you looked at the local markets, it is less deep. It's not as deep as the international capital markets. So issuance in the local markets goes from $50 million to 500. More than $500 million in the local markets feels like that is a lot. So you need to move to the international capital market for size. And tenors are 5 to 7 years, the sweet spot. You have sometimes 10 years or longer, but most of the issuance happens between 5 and 10 years and 7 years. When you think about countries, where the split between countries, like the two big countries, Brazil and Mexico, they represent 50% of the issuance. When you go to the Andean region, we call Andean region the Colombia, Peru, and Chile represent 30% of the issuance. And then the small countries represent 20. And the small countries are countries that you don't have on the radar: Dominican Republic, Guatemala, Panama, Costa Rica, El Salvador. Those count for 20% of the issuance, which is because they don't have local markets in those countries. They tend to, every big issuance that don't go to the loan market goes to the international capital market. So we don't have in the small countries the local markets comparison or competition to the international capital markets. That's why they represent, even though they're small countries, a good chunk of the issuance per year.
It's quite interesting what you mentioned about the larger countries or economies having the option of deciding between the local market and international market in order to cover their financing needs, whereas the smaller countries only having the international market as their funding source. Now that we've covered that, can you speak a little bit about the windows of opportunity that the borrowers in the regions have, how they access the market, and as well as how people think about pricing the credit risk in the region?
Yeah. So when you think about windows of opportunity, you need to qualify by the type of sources of funding. So we talked about local markets, syndicated loan and bonds, international bonds. So local markets is always open. It is a traditional financing source for these companies. It's local currency. It's all local investors that know those companies very well. Interestingly, that market is such that moves from fixed income to equities. So you have migration from fixed income to equities. It's not much. That market suffers, in the fixed income side, suffers when the equity market is booming and there's a lot of opportunities because the assets under management migrate to the equity side, which is not what happened in the US. So that's one of the effects, but usually it's always open at very good levels. The syndicated loan market is also always open because it's basically two things. One is relationship lending, and second is the largest companies in the region, the best credits in the region. It's highly concentrated on high grade. Because of those two factors, even in 2022, for example, when the international capital markets was going through tough times, the syndicated loan market was wide open. In the case of the bond side, the windows are not as clear as in the US, because you basically are correlated to two main factors. One is what's going on in the US capital markets, particularly US rates. We are highly correlated to US rates. And second is all the idiosyncratic events that I described before that happening in Latin America, from political cycle to FX volatility to commodity prices, et cetera, et cetera. So you need to put the two together to start finding windows. Still, we have a ton of windows during the year, but not as many as a high-grade issuer would have in the US. When you think about pricing, I think that a couple of interesting factors here. Number one is that when you compare a similarly rated company in the US with the similarly rated company in Latin America, they usually in the investment grade land, they trade around 75 basis points wider in LATAM than the counterpart peer, similarly rated peer in the US. Today we're at 60 basis points, but usually the average for the last 5 years has been 75 basis points. When you go to high yield, it is 100 basis points the average, and today we're at 75 basis points. So clearly Latin America pays a premium over what the similar rated company pays in the US, and that creates the crossover demand. Sometimes when the markets are really good in the US, what the US investors that invest in the US capital markets, they do crossover investments into Latin America, picking up in some of those names that they can give them more yield with the same rating.
It sounds like it's a good time to be accessing the markets because relative to where they would price vis-a-vis a US credit, the pickup today is not as much as they would pay, on average over time. Can you quickly walk us through what the current market conditions are in Latin America. How would you describe market conditions for financing right now?
Couldn't be better, because if you have these three factors combining right now, which are number one is basically the resiliency of the economy in both in the US and in Latin America, given what's going on globally. Number two is that the prevailing low spreads, we are probably only 30 basis points away from the lowest spreads in the last 30 years in LATAM. And number three is a strong technical position that we have. So let's go one by one. Number one is the resiliency. So we had a lot of news coming from the trade side, uncertainties coming from that, plus all the geopolitical uncertainties as well. So when you put all of those together and you see how the economy is performing, both the US and Latin America is extremely resilient. And that is creating some confidence factor into the investor base about how we can navigate these periods of uncertainties that we are exploring right now. Number two is preventing low spreads. I mean, we are at very low spreads in the market, and that creates the incentive for the issuers and borrowers to basically print. So you need two to tango, and sometimes you need a combination of good factors in terms of cost of financing and liquidity to have a large volumes of issuance. Otherwise, we have what happened in 2022, that the yields were too high, investors were willing to put money to work, but nobody in the issuer side or borrower side was willing to print because they have other alternatives. As we said before, the Latin American companies, they have alternatives in the local markets and other sources of financing. So then the third thing is strong technicals. Latin America has been net financing negative for the last 4 years. What does that mean? If you start putting everything that is issued per year, minus the coupon pay, minus the tender offers, and minus the amortizations, we've been, for the last 4 years, the asset class Latin America corporate bond has been giving money back to investors in the order of around $55 billion. So that technical position is such that investors has been shrinking the asset class, having less exposure to the region. And again, that is creating the technical positive to be willing to put more money to work.
Thank you for that. Clearly, you can beat those conditions. It's effectively the call to action for folks with responsibility to raise funding in the market. Now, if you were to give them a word of advice for the rest of the year as they monitor and navigate market conditions, what would you suggest for them to keep an eye out, or kind of what keeps you up at night as you monitor market conditions?
So obviously, when you are in a market that is strong and with very high valuations, which means very low spreads, you don't have much room to improve. So at the same time, if you look forward, you see a lot of uncertainties in the global economy. You see geopolitical risks out there that are very high. You see fiscal deficits around the world that they are unsustainable, that they can create a slowdown in the economy around the world. So you have so many factors of risk out there that are not being priced in the market today, and you are almost priced to perfection. And usually the issuers or borrowers in Latin America, they are always asking the same, is, shall I wait for the treasury cycle or the interest rate cycle in the US to start slowing down so I have a better yield? And they always want to basically tap the market in the perfect moment. But I think that there's a lot of risks out there to be taking that risk, and the market is liquid enough right now. There is one idiosyncratic trend that is happening in Latin America. I think that Latin American economies, they have something to win from the deglobalization of the world economy by being a good proximity to the US and being a good friend and partner of the US, and being the US the largest consumer country in the world. We have a lot to benefit from that deglobalization process, which hopefully the countries will proactively take advantage of. Number two is that we are in the middle of a political cycle or political elections in Latin America. So in 2026 will be marked by presidential elections in Colombia, Chile, Brazil, and Peru. The people are expecting those elections will go to the more market-friendly, business market-friendly government. So that can be a good cycle for business for Latin America in the years to come.
Liso, thank you so much for such an interesting conversation. I'm sure our listeners will find it fascinating.
Amaury, thank you very much. It's been a pleasure, and let's do it again.
Absolutely. And thank you to our listeners for tuning in to another episode of What's the Deal. We hope you enjoyed this conversation. I am Amaury Guzman. Until next time.
Thanks for listening to What's the Deal? If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. This material was prepared by the Investment Banking Group of JP Morgan Securities LLC and not the firm's research department. It is for informational purposes only and is not intended as an offer or solicitation for the purchase, sale, or tender of any financial instrument. Copyright 2025 JP Morgan Chase & Company. All rights reserved.